This is not just another passing fad. That fiery declaration might feel like it belongs to some tech visionary defending the latest gadget, but it was delivered by none other than the chair of the Federal Reserve. Confused? Astonished? You are not alone. Welcome to a world where digital currencies, once dismissed by many as nothing more than internet illusions, are steadily claiming their place in the mainstream spotlight. Today, we are unraveling the untold story behind that remarkable shift. Eager to know how these once controversial tokens have gone from the fringes of the tech community to the halls of the highest financial regulators? Are you curious about why the Federal Reserve Chair is suddenly giving Bitcoin and other crypto assets such unexpected praise? Or perhaps you have heard the echoes of concern about stablecoin risks, novel technologies in banking, and the potential upheaval in traditional finance. In this episode, we will examine all of it in detail. We will dig into how the United States Federal Reserve's stance on crypto is evolving, why certain banks insist on diving into digital asset services, and how the entire conversation has the potential to redefine financial life on our planet. Strap in, because this is about to get exciting. In this deep dive, we will explore three core questions. First, what precisely changed in the Federal Reserve's position that has spurred the shift in its leadership's discourse? Second, why are certain lawmakers like Senator Cynthia Lummis so adamant about pressing the Fed for answers on stablecoins, distributed ledger technology, and novel banking practices? Third, can we really expect a new horizon in which Bitcoin, Ethereum, and a host of other crypto assets are recognized within the heart of mainstream financial protocols? By the end of our journey, you will not only have answers to these pressing questions, but you will also see how all of these developments might alter the structure of global finance. All set? Then away we go. To really understand the significance of this paradigm shift, we need to revisit the tumultuous journey that crypto has undertaken in the last few years. It was not so long ago that Bitcoin was seen only as a rebellious offshoot of the internet's developer community. Early believers cherished the coin for its seemingly radical promise to decentralize finance, to wrest control from the institutions that some felt had grown complacent and arrogant. The dream was grand, but the skepticism was just as intense. Many traditional bankers and policymakers were quick to label these cryptographic tokens as mere instruments of speculation. Yet as time went on, more and more respected voices, from well-known investors to high-profile business figures, began rallying behind the potential of blockchain technologies. They spoke of a future in which borderless payments, near-instant settlements, and user empowerment were not a utopia but an everyday reality. While wild fluctuations in asset prices occasionally caused alarm, these moments also served as catalysts, provoking spirited debates and attracting more participants into the discussion. By the time Bitcoin had soared to significant valuations, the watchful eye of regulatory institutions became impossible to ignore. Different agencies proposed rules, guidelines, or even warnings. Some were supportive, seeing the seeds of a promising transformation. Others were hesitant, worried about the untested aspects of these assets. And amidst all that, the Federal Reserve, arguably the world's single most influential central bank, appeared to keep a safe distance, standing behind comparatively discreet statements that seldom ventured beyond cautionary advice. That is, until recently, when we witnessed a moment that almost felt surreal. The chair of the Federal Reserve explained openly that Bitcoin and crypto assets are no longer side curiosities, but have reached a level of maturity. What prompted this declaration? Much of it stems from the series of new data points, ongoing dialogues with lawmakers, and the undeniable presence of crypto in everyday financial chatter. It is not only hedge funds or wealthy early adopters who are dabbling in digital currency now. Over the last few months, more average consumers have been hearing about crypto solutions from advertisements, from mainstream bank representatives, or even from their parents. Banks themselves are a huge factor in this transformation. A number of them, from prominent international institutions to smaller state-chartered banks, have been quietly testing the waters. Some are offering crypto custody services, others are investigating the feasibility of stablecoins marketed to reduce volatility, and still others are exploring how distributed ledger technology might streamline the costly back-end processes that banks must manage. The entire banking sector sees ample opportunity in the technology, but with opportunity comes risk. And that is why the Federal Reserve's policy statements have garnered such attention. In an earlier policy stance from the era of the prior presidential administration, the board made it clear that it believed issuing tokens on public decentralized networks might be in conflict with safe banking practices. Critics viewed that statement as a contradiction. How can an institution champion financial innovation on one hand, while practically discouraging the very essence of decentralized crypto on the other? That tension sparked fierce debates in financial circles. Were stablecoins the central bank's path to bridging tradition and innovation, or were they an existential threat to the regulated banking model? Then we saw the involvement of a key voice, Senator Cynthia Lummis. She decided to shine a spotlight on an ambiguous corner of banking laws known as Section 913, which grants the Federal Reserve Board the authority to regulate the activities of state-chartered member banks. The question soon became, how does this law intersect with the new digital frontiers of blockchain and crypto? Lummis inquired what specifically had changed since the Federal Reserve's earlier statements. Had the underlying risks evolved, or had the Federal Reserve's perspective on them changed instead? Enter Jerome Powell, the Federal Reserve Chair at the heart of the story. He responded to Lummis by acknowledging that the industry has matured and that the government's and the Fed's understanding of crypto has likewise advanced. Powell's words signaled more than a simple admission. They cracked open the door to a new era where the Federal Reserve would more actively engage. While he underscored the need for prudent risk management, he also stated that banks should have the freedom to select their clientele and adopt new business models, providing they operate in a safe and sound manner. You might be thinking, wait, so is the Federal Reserve actually cheering for crypto, or is there still caution in the air? The truth is more nuanced. Powell's statements reflect a balancing act between recognizing the unstoppable wave of technological innovation and fulfilling the Fed's mission to protect the stability of the financial system. Earlier chapters of cryptography's journey had banks and regulators in a cat-and-mouse dynamic. Now, it looks like that dynamic is maturing into a more cooperative dance. But does that mean a complete embrace? Perhaps not yet. What is clear is that the conceptual shift from condemnation to cautious collaboration is enormous. The Federal Reserve rarely tosses around words like maturing or becoming mainstream without a deliberate purpose. Indeed, it raises the prospect that many stateside banks may lean into crypto services in the near future, especially as the public becomes more open to partnerships merging traditional banking with digital asset investments. In the midst of this environment, we cannot forget stablecoins. These tokens aim to offer the convenience and speed of digital currency while maintaining a relatively stable peg to national currencies. Skeptics once dismissed stablecoins as overshadowed by established cryptocurrencies, but many professionals now see them as a powerful middle ground between national monetary policies and a budding decentralized economy. A stablecoin that is well regulated could open up an entire universe of near-instant, borderless financial services. But what is the catch? Regulators want to be sure these stablecoins do not undermine the broader stability of existing financial systems. If a stablecoin or a cluster of them fails catastrophically, the reverberations could be felt by unsuspecting bank clients or financial markets. And everyone expects the Federal Reserve to prevent that. Of course, the cynics out there might claim this is all a smokescreen. They might say that the Fed is just giving lip service to modernization, while retaining the power to hamper the crypto industry if it so desires. Many still remember how, not too long ago, certain banks restricted customers from using their own money to purchase crypto assets, citing risk concerns. Some recall how other banks hesitated to open business accounts for crypto-related firms, forcing entrepreneurs to rely on less conventional financial partners. So, is the Fed genuinely interested in supporting a healthy crypto ecosystem, or is it prepping a more controlling approach? Now, right at the crescendo of this debate comes our first call to action. If you are as intrigued by these twists and turns as we are, consider tapping that like button to let us know you want more deep dives. We value exploring these cutting-edge stories, and every bit of support helps keep these investigations going. So, if this resonates with you, go ahead and show a little love. Moving on, there is a practical dimension to all this that hits close to home. If you have ever worried about your bank's handling of your precious savings, or if you have been frustrated by lengthy wire transfers, then the promise of faster, cheaper, and more transparent payment systems undoubtedly grabs your attention. Advocates of blockchain-based banking tout the technology's ability to reduce operational friction, remove middlemen fees, and give you real-time access to your funds. Meanwhile, those who prefer the existing system speak of reliability, familiarity, and consumer protections. But maybe, just maybe, there is a place where the two worlds can work in unison. The Federal Reserve, after all, is not a monolith. It must respond to economic realities, and it cannot ignore consumer demand. If enough people keep turning to digital assets, banks will want to cater to that demand. The real question is how. Will it be through controlled billion programs that use stablecoins pegged to the United States dollar? Will it be through a transformation of central bank policies in an attempt to develop a central bank digital currency? Or will banks be given free rein to innovate as they see fit, as long as they comply with general safety standards? Powell's recent remarks about reevaluating certain policy statements from the previous presidential term suggest that we are on the cusp of some new guidelines. Those guidelines could clarify what is permissible for banks that want to engage with Bitcoin, stablecoins, or even highly specialized decentralized finance solutions. Or they might impose restrictions intended to safeguard depositors, monitor the sources of funds, and keep an iron grip on the quantity of money in circulation. With so many unknowns, the tension builds, and the entire financial community holds its collective breath to see what comes next. Senator Lummis, in her line of questioning, essentially admonished the Fed for failing to recognize an entire slice of the financial sector that has grown exponentially in recent years. She wanted to know if the Fed's understanding of stablecoin risks and distributed ledger technology had become more refined, or if it was simply bowing to political or industry pressure. Powell's response was measured but revealing. He validated that regulators across agencies were collectively scrutinizing the crypto space anew. The days of loosely formed guidelines and bland disclaimers appear to be ending. In their place, we might witness something more structured, more dynamic, perhaps even revolutionary. But is that good or bad for cryptocurrency enthusiasts? On one hand, they might worry that once the Federal Reserve steps in, crypto's original vision of decentralization will get watered down by red tape. On the other hand, a more stable, regulated framework might spur mainstream adoption on an unprecedented scale. Think of it this way. Major institutions often hold back from fully embracing new technologies if the legal environment is murky. Once the lines are firmly drawn, projects can flourish with fewer unknowns. We might just see new alliances formed between banks, tech companies, and regulators. That leads us to an intriguing subplot: how this open acceptance might affect the global positioning of the United States in tech leadership. The immediate arms race is not about ballistic power, but about technological might in financial realms. If the United States sets a workable framework that fosters innovation and mitigates risk, it could become a magnet for blockchain entrepreneurs from all over the world. Conversely, if the guidelines end up being too restrictive, innovators might flee to more accommodating jurisdictions. In a globalized world, the regulatory environment can make or break a country's leadership in cutting-edge industries. Remember also that we are living in an era where data breaches and financial swindles generate daily headlines. Crypto, for all its bright side, has been tarnished by unscrupulous characters exploiting naive investors. Widespread regulation might deter that brand of predatory behavior. People new to crypto might feel safer getting involved when they see that major banks have the green light to operate with stablecoins. By extension, consumer education could improve, leading to more prudent decisions when dabbling in these emerging forms of digital wealth. Now, we come to a pivotal moment. If recent statements from the chair of the Federal Reserve captured your interest, you are going to want to stay tuned to future developments. And here is our second friendly invitation. If you are passionate about uncovering the real stories behind the headlines, consider subscribing to our channel so you do not miss our upcoming discussions. We plan deep examinations of how banks might incorporate stablecoins, what technical hurdles still lie ahead, and which new congressional proposals might fortify or challenge the current momentum. We do not want you to miss a beat. We are nearly at the point of decoding how all these pieces fit together. Section 913 might soon be reinterpreted to clarify what is possible for banks that want to roll out their own tokens. We could see stablecoins minted by major financial institutions, opening the door to lightning-fast services for lenders, merchants, and consumers. We might witness a reimagining of how risk is defined and managed in the context of novel blockchain-based assets. Perhaps the days of being trapped between either a purely decentralized platform or a purely centralized one are numbered. In the near future, a hybrid approach, harnessing the best features of both, might arise under the watchful eye of federal and state oversight. But caution is still warranted. Powell and others in high places have not ceased to remind us that significant hazards remain. Price volatility is a reality for many crypto assets. Stablecoins can face liquidity pressures, and hacking threats still loom large. Nonetheless, the tone has shifted from total alarm to measured readiness. Policymakers appear to believe that with the right frameworks, the good can outweigh the bad, and that redefines the conversation about how tech and finance converge. To some, it feels like a watershed moment. The Federal Reserve rarely changes its tune so publicly without being spurred by decisive changes in market dynamics. The fact that banks themselves are experimenting with crypto-related products is also telling. They see customer demand. They see the possibility to streamline settlement processes. They sense that early adopters might gain a competitive advantage. If the Federal Reserve truly supports these ventures, with practical guidelines that encourage experimentation, America's entire financial landscape could look remarkably different in the coming years. The real test might be how these changes impact everyday citizens. If banks adapt user-friendly crypto services, depositors might one day shift seamlessly between their checking accounts and stablecoin holdings, zipping funds worldwide in seconds, all at minimal cost. Small businesses could receive cross-border payments from clients in distant economies more rapidly than ever before. And maybe, just maybe, the consumer's relationship with money management will be transformed in a fundamental way, providing new forms of empowerment and access to financial instruments that used to be off-limits or too expensive. Yet, we must also highlight that if strong oversight is lacking, unscrupulous forces could exploit the system in new ways. We have all seen illusions of easy wealth overshadow common sense. Indeed, part of Powell's impetus to speak up about mainstream adoption is to ensure that speculation remains in check, and that the industry's future is built upon robust infrastructure. Think of it like constructing a skyscraper. If the foundation is sound, the building can endure storms, but if we rely on borrowed hype without tangible support, everything might crumble under pressure. Where do we go from here? From the vantage point of many industry observers, the next year or two will be crucial. The Federal Reserve is likely to finalize or revise guidance on banks' involvement in digital assets. Congressional discussions might also shape the regulatory perimeter around stablecoins, determining whether they are a legitimate complement to fiat currencies or an unwanted competitor to central bank prerogatives. Meanwhile, the rest of us wait to see whether new breakthroughs in blockchain technology can deliver on the ideals of frictionless finance. No matter where you stand, whether you are a skeptic, an avid believer, or someone genuinely intrigued by the possibility of a crypto-infused new world, it is becoming clear that the days of ignoring or ridiculing digital assets are fading fast. When the ultra-powerful chair of the Federal Reserve states that crypto has become mainstream, that is not simply a rhetorical flourish. It is an invitation for the entire financial apparatus, from local credit unions to global banks, to look deeper and ask how these tools fit into a changing economy. Perhaps the most fascinating part is the broader societal angle. If regulated banks can indeed embrace the spirit of blockchain while providing secure, tested infrastructure, we might see a future that redefines personal financial freedom. People who previously found themselves locked out of traditional finance might enjoy more accessible options. Peer-to-peer transfers could become routine and near-instant worldwide. Businesses might find cheaper, faster ways to settle cross-border transactions. And in the midst of it all, economists and lawmakers will have to grapple with how to maintain the Fed's monetary policy prowess in a landscape where private cryptocurrencies exist alongside official currencies. As we close this epic exploration, remember that we are at the cusp of a new chapter in financial evolution. Despite lingering uncertainties, transformations that seemed impossible mere years ago are now on the horizon. The once curious phenomenon of digital assets is quickly asserting its permanence, and the world's top financial guardians, from the Federal Reserve to major commercial banks, are waking up to this reality. So, keep your eyes wide open. The next announcement from Powell, or the next hearing in the Senate, might well contain a clue about how your money and your connection to the global financial stage will function down the road. We will be here to translate every bit of that journey. Until then, stay informed and stay open-minded, because the revolution in finance is not just coming. It is already knocking at the door.